we keep you coming back. If I love you, love me right back. Don't ever leave me, girl, don't do me that. So please stay, don't walk away. Give me another chance to love you the right way. Yeah. My true feelings pushing out. Woman, you love me, can't do without. Yeah.
Who am I without you by my side? Every little piece of my heart broken in the dark, wishing I could hold you now. When you were here for me, I was not there for you. I was so blind, couldn't see what you done for me. Now I don't know what to do. I'll be right here for you. I'll be calling out for you. Can you hear me?
Think of me, I want a big bright smile just glow. There's no us without you, girl. And when we're looking on the future, see you, girl. My true feelings pushing out. Woman, you love me, can't do without.
I need your love, I need your love, I need your love. Let me love you. Say my name, say my name, name. Say my name, say my name, name. Say my name, say my name. If no one is around, say baby I love you. You ain't running game. Say my name, say my name. You acting kinda shady. Ain't calling me baby, but it's sudden change. Say my name, say my name, name. Say my name, say my name, name. Any other day I would call, you would say, baby, how's your day? But today, it ain't the same. Every other word is yeah, okay. Could it be that you are at the crib with another lady? If you took it there, first of all, let me say, I am not the one to sit around and be played. So prove yourself to me. Am I the one that you claim? Why don't you say the things that you said to me yesterday? You said that I am assuming things. Something's going down, it's the way it seems. Shouldn't be the reason why you're acting strange. Nobody's holding your back for me, 'cause I know how you use me. You say everything to me times two.
All right, good evening to everyone that's already inside the hall. Thanks for coming in early. I hope you have a great dinner just now. All right, so we'll start the program very soon at 7 p.m. All right, so just kindly wait for a moment as we let more people from outside stream into the session. All right. Okay, so later on, as when we have the Q&A, all right, it'll be through the pigeonhole system. So you can see on the sides, right, the two sides, there's the pigeonhole, the code to enter. You can scan the QR code or key in the code itself to enter the pigeonhole Q&A session. For those online as well, you also have the pigeonhole access to actually join in the Q&A. Okay, so we'll start very, very shortly. May I have assistance to switch the slides over? Okay, so I will start the session slowly, right, as an introduction. Right, so my name is Huan Zhi here. I'm from Philips Securities. I'm a dealing manager of the branches. All right, so right now I'll just share some of the promotion as we get more people to stream in to the session, which will be starting. Right, so one thing is that, not sure if you're aware, if you're already an account holder for Philips Securities, you can actually refer your friends if they are not already users. And for each successful referral that you make, you can actually get $68, up to 10 by default. But if you have more than 10 friends, feel free to reach out to us. We can actually work something out for you to refer your friends. All right, so as you refer a friend in, they need to do certain tasks, all right, like just funding the account will do. Right, open account and fund the account. So they must be new users of Philips Securities. Okay. So you can scan the QR code if you're interested to find out more about the Refer a Friend program. Okay, or just take photo of this slide. So the link below can be used as well. The next thing we do have the share financing. All right. So if you are actually looking to leverage your exposure or you have a portfolio of shares already that you do not want to liquidate, you want to hold on for long term, but yet you want to tap onto this shareholding or portfolio that you have for more trading opportunity. The share financing accounts that we do have for the margin account, right? So currently the rate is 4.8%. I know it's slightly high, but then you look at the interest rate environment, it's going to go down. And actually some of the banks or even REITs are already giving more returns of dividends than the 4.8% already. So you can start to look at it as an opportunity for yourself if you're looking to do a short-term leverage play as you so-called capitalize on opportunity as the interest rate is dropping. All right, next we do have the Gen DLC. So I think some of you have get to know about the booth outside just now for DLC. So if you trade 2 times, you do 2 buy trades, you're actually entitled to this $88 cash credit to your trading account. Of course, you must be new traders of DLC. If you already traded DLC over the last 6 months, then you might not qualify. But then if you trade it by end of this month, 30th of April, 2 separate buy trades, not same day, but separate day, 2 separate buy trades, then you'll be entitled for this cash credit. You can take a look, right? These actually have quite a few options to actually trade on the indexes, on both the long and the short opportunity, as well as Singapore and Hong Kong, some of the popular counters. Next, we do have the new SDR. I think if you have finished the booth outside, you also find out that we have this new SDR. So 5 counters added, total now 8 counters for SDR. So the 8 SDR counters right now will have a promotion of 0 commission. It's for you to try out to see how you can get exposure into the Thailand market. All right, so you get exposure into it through 0 commission because of account type with Philips Securities. Right, so this is for Philips Securities. If you're using other trading house, you might not be 0 comma. Just note that. So if you want to open an account, just look for our staff outside to assist you. All right, so this promotion will be from 1st April to 30th June. All right. So next thing is also for Telegram group. So if you are not yet already joined from the QR code outside, you can just join through this QR code over here to join for market update from the Philips Center side. All right, so next slide also will be sharing on the QR code for Telegram for SGX itself. This is for the Philips Securities end. All right, so if you wish to join the Telegram for market update, you can take a look at this QR code. So next we have the SGX one. This is for SGX. They have the 2 different QR codes, one for the newsletter and one for their SGX Invest Telegram group. Right? Okay, so later on we'll be sharing more details. Okay, so take note, for any Q&A for sessions later, right, do put them into the pigeonhole as per this slide, the code itself, 3APR24. All right. Okay, so without further ado, let me pass the time to Jeff who will be sharing more of the market outlook and the macro update. Thank you.
Yours, Captain Marble. Good evening, ladies and gentlemen. Great to see you. I'm going to spend about 15 minutes or so giving a quick rundown on trading in the bank sector and the REIT sector here in Singapore. They both have been very important aspects of our stock market, which we're going to talk and share some education and insights with you on. I think the banks in particular have been a large part of the STI's competitive performance since the end of 2019. In US dollar terms, the STI has generated an 18% total return since the end of 2019 through to the end of the March quarter. And that has in large been a part of average 50% total returns for the three banks of DBS, OCBC and UOB. At the same time, our iEdge S-REIT index has declined around 9% in total return terms since the end of 2019. As you can see, for the STI, we have well outperformed the region. The FTSE ASEAN Extended 60 Index is an index you're probably going to see more of in the next couple of years. It's something that FTSE Group have worked on. This ASEAN Extended 60 Index, it has quite a heavy weight to Singapore. It's about 37% weight to Singapore. And despite this index being 37% weighted to Singapore, you can see how it has returned single-digit 3% since the end of 2019. But when you look at the majors, that is FTSE APAC ex-Japan, which was up 14%, and then FTSE APAC, which includes Japan, was up 22%. You can see we're right midpoint between the two returns of those two key regional benchmarks. Going into this year, we had pretty good high hopes, if you will. GDP in Singapore is expected to double up. Global trade is expected to triple up in terms of merchandise trading volume. And we did come into this year thinking, a lot of the market was thinking that we'd see financial conditions start to be a little bit more accommodative in as early as the first quarter of this year, but expectations have moved into potential for interest rate cuts not to come in March, but to come in June. This has had a really strong, dramatic effect on the pricing of the REITs, which I'll show you in a couple of slides' time. But what's really important too, as I said, the banks have generated those 50% total returns on average since the end of 2019. And with that, I've lost my train of thought already. This is going to be hopefully not too much of a long 15 minutes. But what I'm trying to say is that the banks make up 50%, almost 50%, now 49% of the STI. Okay. I'll go into the banks as well and talk about their profitability and so forth. We did think in that MAS professional forecasters release in December that corporate profitability would be quite a lot stronger. Expectations for corporate profit growth went up from 33% in September last year up to 57% in December. So we were looking at a pretty strong 2024. We got no update in March on corporate profitability, but what we did get is an upgrade to the outlook for loan growth in Singapore, which is very important for the banking sector. Loan growth revisions were up from, it was an upward revision from expectation of 2.5% loan growth in 2024 to a 3% loan growth in 2024. That's a really important aspect of our GDP, the financial services, which is very relevant to what we're talking about tonight. Now, the banks themselves have a really strong dividend appeal, and it's actually the banks themselves that give us that branding of being high dividend market here in Singapore, more so than the REITs. I'm going to show you that in the next slide. But I just wanted to point out two more things for the broad market is that we have seen, as we said, the STI generate those very competitive returns of the region, the two big regional benchmarks. But what's actually outperformed everything is, of course, gold. Gold's up something like 42% in US dollar terms since the end of 2019. That's the gold ETF that we have here. And of course, that is because of geopolitical tensions remaining on the radar all throughout the course since the end of 2019. So there are three big global macro forces that our markets here are contending with, particularly the big mega sectors like banks and REITs. That is the tighter financial conditions, which we'll talk about, the outlook for China growth, China property market, the strategic initiatives China is doing to reinvigorate its industrial sector. This is all a very big overarching part of our market. And then, of course, the geopolitical tensions, which we have gold as the ultimate market for that. Overall, Singapore retail investors since the end of 2019 have been net buyers every single year in our stock market to the tune of about 15 billion Singapore dollars of net retail buying. Now, when it comes to the banks and the REITs, there's a very similar, I guess, revealed preference showed by retail investors, and that is they like to buy more when we have underperformance, low valuations, more so than when the market is trending upwards. Case in point was, as I've said before, the biggest trade I've ever seen in this market was retail investors net buying our biggest stock by market cap, DBS, in 2020. Net retail inflow was about 1 billion Singapore dollars. The volume weighted average price was around $21. And then in 2022, the retail investors flipped that trade, sold it when the VWAP was around $28, and the net retail outflow was around 1.1 billion Sing dollars. It's similar to 2022 when we were among the best performers across the world, second best to Brazil in terms of the benchmark performance, and outperforming US by something like 15, 20%. That year, we saw the least amount of retail inflow. So there's clearly, what we have seen over the last 4.25 years is a preference for investors to be buying during the lows and so forth. And that's a tough one for us too, because we are running the education at SGX. We need to be distributing content, helping the messaging, sometimes not so much looking at the perspective from SGX, oh, it's a good market, it's performing well. But for the investors, I think the investors prefer to see not great Singapore sale, but something akin to that. So we're trying as much as possible to bring out some of the potential value stocks, that is stocks that have positive total returns over a 12-month period, yet have a single-digit PE, double-digit ROE, or a PB value, which is trading at maybe half, or an price to net asset value, which is maybe half its book or asset value. I should be as quick as I can. So we have lots of sectors. It's not just banks and REITs, but I thought it'd be very useful to show you how banks and REITs have fared for each quarter since the end of 2019. And you can see a lot of the performances of these sectors have, in many ways, been textbook performances. As you can imagine, during 2020. Maybe I can use it. Yeah, I'll use the pointer here. During 2020, as you'd imagine, travel and hospitality stocks underperformed the overall market. During your telcos were the most defensive in the first quarter of 2020. Manufacturing outperformed in the second quarter and the third quarter of 2020. We all remember why, because they weren't facing their customers and their consumers in their services. They could be strategically operating and not have to reduce their numbers and observe social distancing. But come right forward into where we are now, you can see what's been happening last year. So last year, the amount of sector diversity we've got, right? So if you look at the STI and say, okay, low single-digit performance for last year, but if you look at a composite of the 4 best performing sectors last year, which for most of the year were travel and hospitality stocks, and I'm just taking 3 simple stocks, the average of the travel tourism arc. I'm just taking Singapore Airlines, Genting Singapore, and Comfort Delgro. Comfort Delgro, chunk of its volumes, sales revenue is from outside Singapore, but around 60% is here in Singapore. Just a caveat there. So just looking at those three stocks, and then the three banks as well, the average returns there. Now, see where we are in the first quarter. Can everybody understand why in the first quarter of 2024, banks were up 5% on average, but REITs were down the bottom here as down 7%? Yep, all in interest rate, and particularly with interest rate expectations. So this chart I've got here, the dark blue line shows you the IHS REIT index. The dotted blue line and the dotted green lines represent the expectations that we would have a Fed funds rate cut at the 20th March FOMC, which is the green dotted line, and the dotted blue line, which is in about 4 weeks at the next FOMC. That was expectations. As you can see in March, on the far right of the chart, those expectations are near zero, that we'll have an FOMC cut on the 1st of May. And before going into the 20th March FOMC, you can see expectations had been near zero. We would have that rate cut. But when you look at the end of last year, sort of like midpoint in the graph along the horizontal axis, go to the midpoint and go up, you can see around this point, you were close to 100% expectations we would have a Fed funds cut by the 1st of May, Fed funds rate cut, and then close to also 100% expectations we were going to have a rate cut in March. So that saw a rally in the REIT market towards the back end of last year, which has since come off. So what it's done is created this overall pricing in the REIT market that, as we said, the IHS REIT index is down 9% since the end of 2019. The average or the median price to book ratio of the REIT sector is now 0.7. So on average, they're trading at a 30% discount to their book value. Moreover, when you look at the average 5-year price book ratio of the REITs, and you look at where the price book ratios are now, they are also trading at around 20% lower than where their average is over the last 5 years. So they've been quite stretched. In fact, there's just 4 REITs now that are trading above their price book ratio: Capitaland Ascendas REIT, Maple Tree Industrial Trust, Keppel DC REIT, and Parkway Life REIT. But they're still all trading below their 5-year PB, even though they're trading at PBs above 1. And then you can also look at the consensus estimate target prices on these REITs and all the stocks. And you look at the REITs, because of that interest rate, because of the overarching impact of higher financial costs cutting into your distributable income, your REITs in general are trading at 20%, trading at prices that are 20% lower than their actual consensus estimate target prices. Whereas the banks are trading around 5% lower their consensus estimate target prices. So you can see there's quite a distance there. Even some of these REITs, so Parkway Life REIT, for instance, so the 2 best performers over the last 5 years in the REIT market that are around 40% total returns, Keppel DC REIT and Parkway Life REIT. Parkway Life REIT, something like 40% total return for the 5 years ending the March quarter, yet it's still trading below its 5-year PB, but it's also trading 28% below its Refinitiv consensus estimate target prices. And those target prices we've got on our SGX stock screener, and they're updated every hour or so for when Paul and all his cohorts and counterparts update their target prices and their ratings on these stocks. But nonetheless, we are extremely diversified in the REIT market we've got. Diversified REITs make up the bulk or the bulk of the trading on a day-to-day basis in the REIT market. If you consider how strong we are in REITs globally, REITs make up around 2%. Global REITs make up about 2% of global market cap. They make up 12% of Singapore market cap, and at the same time make up 20% of our day-to-day turnover. And we now have 7 REITs back in the STI, around 13% weight of the STI. On average, the REIT dividend yields are around 7%. There's about 5 REITs that have discontinued or suspended dividend payments. So the majority, 35 thereabouts, are still maintaining yields, which on average are around 7%. The average gearing ratio of the REITs is at 39%, and the majority of REITs have a gearing ratio limit of 50%, assuming they have an interest coverage ratio of at least 2.5 times, and the average interest coverage ratio of our REITs is around 3.9 times. One of the highlights of last quarter was Fraser Centrepoint Trust moving into the STI. This is the first time a Singapore pure play was actually going back into the STI in 8 years. Now, this REIT, when it listed, it had AUM, or a portfolio value, of less than 1 billion Sing dollars. The AUM is now 6.5 billion Singapore dollars, and it's generated average annualized returns of around 10% since inception. So I guess what I'm trying to say is, overall, the market is trading at a pretty solid 30% discount to its book value. We have marginally underperformed the FTSE EPRA REIT index since the end of 2019. That index is down 3% versus our 9% decline. But there's a lot of diversity in what we call our global REIT hub. There's REITs that have actually increased their distributable income and their distributions per unit for their FY23. All 5 hospitality trusts, 4 finished at the end of last year. I think 1 finished at the end of September, thereabouts. All 5 reported around 20% year-on-year increase in their distribution income, and we know why. It's hospitality. There was a time for that sector, just like industrial REITs had very much outperformed in 2020, 2021. We saw hospitality trusts have their time in 2023 and 2022 as well, to an extent. But this year, also keep an eye on the acquisition front. Fraser Logistics Commercial Trust, Digital Core REIT, Mapletree Logistics Trust, Capital Land India Trust, as well as Keppel REIT, I think they announced on Monday, have also made acquisitions this year. So the REITs are still looking to make yield accretive acquisitions to increase the value of their portfolio. Fun fact, the 320 million 50% interest in 255 George Street that Keppel announced on Monday, that is the building that's directly across the road from the old Sydney Futures Exchange. It's where I used to work a long time ago. Going to the banks, though, and I want to quickly finish. I've really gone over time. I apologise for that. The banks have performed better in this overall higher interest rate environment, predominantly because of their net interest margins. So at a group level, DBS's net interest margins have gone from below 2% in 2022 to above 2% last year. Likewise for OCBC and UOB. And you can see that's what this histogram is showing. We're showing you the SORA, 3-month SORA in Singapore, which has moved in line with the rate hikes by the Fed Reserve. Remember, they began in March 2022, right through to July 2023. And you can see the impact that has had on net interest income. So for 17 quarters thereabouts, the combined quarterly net interest income of the banks came in at around between 4 and 5 billion Sing dollars. And now for the last 5 quarters, it's come in at above 8 billion Sing dollars. Why is this important? Net interest income makes around 2/3 of the total income of the 3 banks. So last year, the 3 banks made 33 billion Singapore dollars in combined net interest income. That was up 22% from 2022. And then they also have a lot of wealth management, card businesses, treasury, insurance businesses as well. That makes up the remaining third of their total income. And that was also up 18% year on year last year. So combined, you had close to 15 billion of non-interest income for the 3 banks total, and you had around 33 billion of net interest income. So that's a combined 48 billion Singapore dollars of total income for the banks. That's an average return on equity of around 15%. And we saw the 3 banks pay declare 11.5 billion Singapore dollars just for their FY23 alone in dividends. And that's what I was saying, what I wanted to say in the beginning, where I lost the train of thought, that the dividends of the banks so high, they're actually at 6% for last year when you look at all the dividend distributions and the last trading price for the year last year. Now, this means that the Singapore banks also punch well above their weight in all the regional dividend tilted indices. There's a lot of indices that don't just look at yield alone, but they look at all the financials and the ability to sustain those high yields. And that's where the three banks always kind of rank pretty highly in these type of indices versus the parent indices that the stocks are selected from. So, as I say, there is a trade-off though. The net interest margins have accounted for a lot of the net interest income growth, but the loan growth hasn't been so strong. So on constant currency terms, last year, OCBC and UOB grew their loan books by 2%, DBS grew it by 1%. We went into last year hoping and thinking it would be single digit, around 5% for the three banks in total. For the banking sector in total here in Singapore, as I said before, we saw the economists marginally revise their forecasts upward from 2.5% to 3% loan growth this year. So that's in essence the other side of how it works. Piyush Gupta has always said that consistently that there is a trade-off. Loan growth, you have the higher net interest margins, but at the same time you see less loan growth, obviously, when tighter financial conditions are in play. Looking at the banks as well, we can discuss in the panel. A lot of them have different views on the region for this year and their outlooks. I know OCBC also were pretty bullish on their outlook for Asia growth versus the rest of the world. UOB, of course, is focused on ASEAN and has been touting ASEAN growth for some time. So digitalisation is also a big common thread in the growth of these businesses, and DBS ranks so highly in global banks on the ROE scale, and the CFO of DBS has been maintaining for a good 7 years or so. Digitalisation has made that possible to have those high productive ROE ratios. Okay, so that's it in essence, what I wanted to quickly cover. The banks themselves, 25 cents in the dollar that goes to work in our stock market every day goes into those three banks. And then you've got about 20 cents in the dollar as well that goes to work in the S-REITs as well. And as you can see, both have performed a little differently in that overarching theme of tighter financial costs. But at the moment, for the Fed Reserve, the projections are that 60% expectations we would have a rate cut in June, but that goes up quite significantly in July because there's 6 weeks between the June FOMC and the July FOMC, but that 6 weeks allows 2 prints of their key PCE core deflator to be released, and which they might look for extra confirmation that inflation is indeed heading towards 2% rather than maybe going sideways here at 2.8. Yeah, so that's my part of the session. Who's next? Paul? Oh, sorry.
Thanks. Okay, yeah. So thanks. My name is Paul, here at Research for Singapore. Today's event is mainly on REITs and banks. But like all concerts, you have to watch the pre-show or opening act, whether you like it or not. So I'm the pre-show and opening act. So I'll just run through some of the macro trends and challenges in Singapore, purely on the macro, just to give you some macro backdrop before we hit on to banks. So for Singapore, I'll just have a few slides on what are the hot segments that's happening in Singapore and what some of the colder segments, so easier for you to understand. Okay, anyway, for some of the hot segments right now, at least for Singapore, is construction. So for construction, as you can see, the blue line is climbing up. The blue line is the contracts awarded, and the red line is built, that means actual work done. But what is not shown here, which we didn't show, is the BCA's forecast. So BCA is probably looking at, historically, if you look at the blue chart now, construction is, it swings up, swings down, it's extremely volatile. But I think the next 4 or 5 years, you're looking at probably 35 to 38 billion. So the outlook for this is pretty stable, which is very unusual because construction tends to be extremely volatile. So those that we like are like building materials rather than construction stocks, which is probably one of the worst around. The other thing that's doing well in Singapore is tourism. So tourism had a lull in the fourth quarter. You can see the dip, but the last 2 months, you've seen a huge spike up again. So this is going to be the natural winners will be hospitality, the Gentings, excluding the luck factor. But those are the winners, and that is another hot sector in terms of in Singapore. I run through the other. Okay, this we shouldn't call it hot. I mean, not the right word. I mean, more people going to hospitals, not a hot sector, but it is something that is climbing up, which is also a strain on the government finances. That's why hospitals are crowded. It does spill over a bit to private hospitals doing this called TC, temporary facilities. Okay, yeah. So these are the temporary hospitals which benefit some of the private ones, but whatever profitability has been kind of bidded out because there's too much competition. But this is one area that's also climbing up pretty strongly, and I guess that's why we also have some of the new medical schemes coming up. The other thing that's hot in Singapore is that there's a lot of money flowing in. Regretfully, most of it, of course, some of it might have flown out because of maybe to Fujian, but most of it is still around. So if you look at you look at the blue line, so that is the current reserve. So just to give you a bit of flavor, if you look at February 20, before the pandemic, we had about maybe, let's say $280 billion US. You'll notice there's an extremely huge spike, then it dropped down, mainly because a lot of it was transferred to GLC to manage some of these reserves. You're probably talking about maybe 180 US billion. So if you add that back, since the pandemic, there's almost like 250 billion that is flown into the Singapore reserves. This may not mean much to us as an equity investor, but it's very meaningful for the Sing dollar, because the three things that holds the Sing dollar, especially why it's attractive to a lot of ASEAN neighbors, is the strength of the Sing dollar. Underpinning it, the Sing dollar is of course the FX reserve. The third is our sovereign debt rating. We're the only Asian country with AAA rated. And the third reason is also we are always in the current account surplus. So the current account, for those who may not know, this is the amount of goods and services that Singapore exports compared to what we import. So 2023, we were probably the highest. Sometimes we lose out to Norway or Saudi Arabia for obviously all reasons, but in general, we are probably around 18-19%. So this is another reason why the Sing dollar, there's another bedrock for the Sing dollar, which in a way, if you look at this side, you probably think Sing dollar is actually kind of undervalued because we have all these positives. But this just to show you that the strength of the Singapore market is, of course, the yield, and namely also because of the currency, especially if you're an investor, probably a non-US denominated investor. But this one holds well and it's very consistent. Every year in and out, we are like 18-19% of GDP, which means there's a lot of liquidity flowing into the country. We sell more than we buy. Maybe we're not consuming now. Okay, the other one that is doing well, I mean, is also the population. So population spiked up a lot. So if you look at the red line, there's a big jump, and the blue bars are the annual changes. So we had a record number of population jump. So this is important because it will help GDP growth. It will help consumption. Indirectly, it might help investments, because if the population is up. So again, this is just 5 slides to let you know what is hot in Singapore. So I'll just move on to what is not so hot, which is colder segment, which is the weaker spots of the Singapore economy. The first one is exports. So of course you can see there's as you look at the far right, there's a rebound in exports, but you're coming off a near collapse last year. So although it's bounced up, but you're comparing with a collapse. If you look at the chart here, 22, 23, it's as bad as almost the pandemic level. It's even the decline is almost comparable to the Asian financial crisis. So exports was terrible last year. Although this year is bounced back up, but again, for us, we think the bounce is very muted. So without a strong export, our GDP is probably one of the highest exposed to exports. So what it means that don't expect the external sector to be a very robust driver to GDP growth in Singapore. The second thing is, jobs are declining, obviously, but I have another chart which I didn't put here because of time, but is that there's a lot of ample jobs. If you look at vacancies, vacancies are, like 40% higher than pre-pandemic. But the part that's slowing down is definitely the jobs are slowing down. So of course, it's not a good sign for us. These are colder parts of Singapore. Property demand. So when you look at this chart, on average, we should be getting 11,000. worst, like most horrible years, if you look at the chart 2013 after the dreadful TDSR, some of you might still have some marks on it, but if you look at TDSR, probably you're hitting about 6,000 units per year. But this time around, you can see the chart is actually worse than almost the post-TDSR. So demand is extremely sluggish. Even though there was kind of a record number of launches this year, last year, and probably another record number of launches next year. But again, my job here is just economist, no? Tell you a lot of things, but may not all be useful because may not be like helpful in your decision making. That's more for the REITs and the banks. But again, that's what economists do. So the fourth thing is wage growth. So another part that is slowing down for Singapore is the wage growth is slowing, but it's still quite strong. You look at the blue line, the growth rate is still like 4-5%. Just that the pace is slowing down. But the level, so you're looking, this is actually the contributions to CPF. So you're looking about 6,000 as the employee average monthly earnings. The second last one is consumer spending. So this will be impactful, if you're looking at some of the Sheng Siongs or whatever, or retail, or you can ask later on the REITs, retail REITs. So retail sales is slowing down. I think it's pretty obvious from the line. Again, the consumer is cautious, high interest rates, although jobs are ample, but I think the cautiousness is there. And finally, this is a bit more structural. So this is the aging headwind we are going to face. So the numbers there, I guess it's more evident we walk in certain parts of Singapore. But if you look at the number of 65 and above, 2014 to 2024, you can do the math, about 600,000. Then there'll be another doubling. So it's almost going to triple the number of 65 and above from 2014, 20 years ago to 2034. I mean, if you next 10 years ahead. So what this means is going to be a big drain on fiscal spending on the government. That's why we have healthier SG, to try to bend the cost curve. But again, this is just I'm economist. I just tell you information. So I'm just going to. So that's why one of the challenges that the Singapore will have is that the aging, and it's pretty sharp. If you look at the blue line, is basically the percentage of population that is going to be 65 and above. What it means that these are not working. It doesn't mean they're not contribution. Just that they're not working, so there won't be a huge contribution to GDP, and there'll be much more social spending that the government needs to do on healthcare and so forth. So in conclusion, like all economists, expect modest pickup in external demand recovery, although modest. But again, the usual comment of uneven recovery, but don't ask me when it was ever even, but anyway, it's an uneven recovery. Structurally, our strength again is just the strong currency, and we have always got that safe haven status. So again, not a high growth, but again, it's the stability and the yield. With that, thanks everyone. So I'll just hand on to the REIT section by Darren.
Yeah, thanks, Paul. So I'm Darren. I'm the REITs and property analyst. So let's move on. Yeah, so this slide, it shows the share price performance of all the S-REITs in their subsectors. So you can see, the words are cut off. The first one is overseas commercial. So for the overseas commercial, you see it's down year to date, 23.2%. That's after it was down 30% last year. So that's mainly weighed down by all the US office REITs, as we saw that their property valuations declined and they halted dividends. So that's the reasons why the share price has crashed. And for last year, industrials were the outperformer at like 8.8%. You see the second chart there. And for the whole index as a whole, last year was up 0.3%. But this year we saw that year to date is down 8.8%, mainly because of the expectations of fewer rate cuts. Like just now, Jeff mentioned that at the start of the year, we're probably expecting about 6 rate cuts. But now we're only expecting about 2 or 3 rate cuts. So that's why we saw that the REIT index the share price really came down this year to date. Yeah, and for the outperformance so far this year is the hospitality subsector. That's mainly because of probably good results from the FY23 full year results. Yeah, from improving RevPAR numbers. Yeah, so I'll move on. So this is the movement in the key interest rate references. So the FDTR, that's basically the Fed funds rate. That's the gray line. You can see over here. So trying to mouse. So yeah, the Fed funds rate is spiked up here. And as a result, the 10-year bond yield also rose in tandem. So how high interest rate affects REITs, there are mainly 4 reasons. So the first one is you affect your, of course, the finance cost. So that's the direct impact. Higher interest rates will affect your basically the REITs will have to pay higher financing costs. The next one is your dividend, the dividend yield spread, basically the dividend yield you get over, or rather dividend yield minus the 10-year risk-free rate government bond. So that yield spread will start to decrease because of the higher interest rates and higher yields. So you get a lower dividend yield spread, which means that you're getting compensated lesser for investing in the risky REITs rather than the risk-free rate. So that is 2. The third one is valuations. So with rising interest rates, cap rates will likely expand as well. So as a result, valuations will likely to decline. So that's what happened to the US office. And the last one kind of slipped my mind. Let me think. Yeah, if I remember, I'll just get back to it later. Yeah, I'll just skip that first. Yeah, so for the sector trend, so this is the 10-year dividend yield spread. Like I was talking about this earlier, the red line is the average. So right now you see that because of the increase in interest rates and the increase in the 10-year bond yields, right now we noted that the 10-year dividend yield spread is trading at almost -1 standard deviations away from the mean. So this doesn't look attractive, but we expect this to widen going forward as the interest rates come down, and as a result, the 10-year yields will also come down. So that will make investing in REITs more attractive. So this, like I mentioned, is basically just how much you're being compensated on top of the risk-free rate, as compared, like investing, when you invest in a risky REIT asset in the equity market, how much are being compensated in terms of dividend over the risk-free rate of the risk-free asset, like the proxy. Yeah, so the next slide is, this one is just a price to NAV. So this is more of the valuations. Right now you see that it's trading about a 0.8 times price to NAV. So this is below COVID-19 lows as well. So COVID-19 lows was trading about 0.9 times price to NAV, and the historical average is about 1.03 times. So that's a red line. Yeah, so because of that, we think it might be a good time because REITs are now trading at a discount, a steep discount to its historical average price to NAV. Yeah, so I'll move on to this slide. So this slide, it shows 2 things basically. One is the dividend yield, forward dividend yield, which is the blue line. Let me see. Let me use the mouse. Like the blue line. So this blue line is the forward dividend yield, and then the shaded area, that is the DPU year-on-year change, change. Yeah. So right now you see, because of the recent share price correction, it is down 8.8%, like I showed in the earlier slides. The forward dividend yield is now trading at about 6.5 times. So that is more than the average. Historical average is in fact trading about 0.5 times above its historical, 0.5 times standard deviations above its average. Yeah, so we think this is a good time as well, because the forward dividend yield you are getting when you invest in REITs right now is you are getting more than historical average, even though the absolute DPU amount that you are getting is lower. You can see in the shaded area. You see over the past, in the past year, the year-on-year decline in DPU, the absolute number is about 8% across the board. That is mainly because of the higher interest expense. Even though some REITs could manage to increase their NPI and their revenue, but the increase could not offset the increase in interest expense as it really shot up really quickly over the course of 2023. Yeah, so that's what this slide is about. Moving on. Yeah, so sorry about the formatting. I think it moved when it shifted to this yeah, so what this slide shows is the S-REITs index versus the Fed funds rate, which means the S-REITs performance against interest rates movement in the Fed funds rate. Yeah, so you can see in the red box, we saw that when interest rates peaked, the S-REITs index rallied during the period where interest rates flatlined at the peak. So it happened twice, one during the GFC period, which is 2026 to 2028, and one is around before COVID period. Yeah, so what we see from this graph also, it shows that even though interest rates rise, it doesn't mean that the S-REITs index will definitely collapse. As we saw the period before the red box, interest rates were rising, but at the same time, as REITs, the index could also increase at the same time. So that is the same with the 2016 to 2020 period. So right now that interest rates have peaked, it could be likely that the S-REITs index will rally as well, especially with the expectations of the rate cuts coming. Yeah, so next is the gearing. So these are some of the REITs, Singapore listed REITs that have higher gearing compared to the peers. So as we know, the gearing MES limit is 45% or 50% if your interest coverage ratio, or rather if the REIT's interest coverage ratio is 2.5 times and above. So for this, we see that most of the REITs right now, with the exception of Prime, are still well within the limits. Like I mentioned, these are the ones that are already at the higher end. And the one that's at risk now is Prime. So Prime, their gearing right now is at 48.4%. That's after the impact of the year-end valuations. So the worry about gearing last year before the full year results was basically whether the impact of the declining valuations, like whether it will decline enough for the gearing to breach the 45% or 50%. So in Prime's case and Core and Manulife, they already breached the last year even before the results. So for Core, which is Keppel Pacific Oak US REIT, they're taking a more conservative stance where they halted their dividends to conserve capital. In this kind of a very weak US environment where leasing is lower and property valuations keep declining. So Prime is also affected by the declining valuations, and as a result, their gearing, it rose from 43% to 48% as of the year end. Yeah, so other than that, we do not see the risk of gearing breaching the MS covenants for now. Yeah, with the exception of the US REITs where some of them have already breached. Yeah, so next, this slide, it shows the average DPU performance, year-on-year performance over the past year. As you can see, the hospitality REITs at the top left-hand corner. So these are the REITs that managed to generate a DPU year-on-year growth, mainly because of the improvement in RevPAR. And the other REIT subsectors, most of it couldn't do so. So as we see, the DPU, it declined. Like you see the bottom right is the one where they halted dividends, is down almost, is basically down 100%. So on average, we saw DPUs were down 20% year on year, mainly because of the high interest costs. Yeah, so moving on to the subsectors that we favor. So we favor the hospitality subsector mainly because we still think there's potential for DPU growth going forward. Like we looking at these numbers, the visitor arrival numbers, we see in February 2024, it grew 50% year on year, mainly because of last year in February they had Ed Sheeran's concert as well as the Singapore Air Show. And this number 1.4 million is only 4% below pre-COVID levels. So with March numbers, with Taylor Swift's concert, we expect the international visitor arrivals to be way higher, or rather surpass pre-COVID levels already. Like for me personally, I was at the Taylor Swift concert, I thought I was overseas. I barely saw any locals, most of it were tourists. And for the RevPAR numbers as well, we are seeing it turn around after 2 consecutive months of decline in November and December 2023. So this year, January had Coldplay and February had the Air Show and Ed Sheeran. And as a result, the hotel RevPAR is also it returned back to growth, its growth trajectory. So it grew 7.9%. Yeah, and occupancy is also holding up well at 83%. And one thing to note is that in February, the hotel average room rate is the ADRs in Singapore. It was the second highest on record, the highest being last year during the F1 period. Yeah, so $298 average daily room rate was the second highest in history in Singapore. Yep, and one more thing to note is that Chinese visitor arrivals, we expect it to increase as well, especially since the 30-day visa-free entry started in February, 9th of February 2024. So since then, we noted that the Chinese year-on-year visitor arrivals, it grew tenfold. So now Chinese is only, the visitor arrivals from China is only 4% below pre-COVID levels. And so that is a huge thing especially for the next slide, like retail subsector, we also favor it mainly because of rental growth, and that is because of the potential for positive rental reversions going forward, especially for downtown malls since the return of Chinese are coming back. So historically, the Chinese are big spenders in the downtown malls and luxury products. So with the increase in Chinese tourism, we expect this number to increase as well, like for rental reversions, like the negotiations that take place with the tenants and the landlords is easier because the expected amount of tenant sales, we're expecting it to grow basically. And that is despite the weak retail sales numbers that Paul also mentioned earlier. Yeah, another thing that will benefit this retail subsector is the fact that the Singapore government is paying a lot of free money basically to Singaporeans, like the CDC vouchers, $600 of it, and as well as some payouts to individual Singaporeans like above 21, like $200 to $400 payout, as well as the NS Life credit. So all these are money going into the economy, and we expect this retail sales to improve because of all these. Yeah, so these are the next two sectors are not the sectors that we favor, and I'll tell you why. So first is the office subsector. So for office subsector, this is basically the CBD average occupancy and the grade A rents for the office subsector. We expect the rents to plateau mainly because of the incoming supply from IOI Central Boulevard Towers and Keppel South Central. So that is due probably this year. So that is about 1.8 million square feet of supply coming on board. And we are unsure whether, or rather we don't think that the demand can absorb that supply that's upcoming or incoming. So therefore, we think rents will likely plateau at 1190 or yeah. So that's why we are not so favorable on this office subsector. And the next is the industrial subsector. For industrial, we are also not so favorable because of also basically the supply. For supply, they have about 2 million square meters of supply that's upcoming, and that is double the average of the past 3 years. Yeah, so we don't think the demand can, especially since macroeconomic conditions aren't doing too good, and yeah, manufacturers are also not expanding that fast. Yeah, so I'll just move on to some of my stock picks. Yeah, so first of it, I basically have two stock picks. So one of it is CapitaLand and Scott Trust. So this one is basically to make use of it's basically part of the hospitality subsector that we believe is prime for growth still. So for Class, we have two stories for it. One of it is inorganic and organic growth. So for organic growth is basically just a portfolio growth in RevPAR. Like we've seen it recover back to pre-COVID levels already. Right now it's at $161 and the RevPAR and is higher than pre-COVID. So going forward, because of the reasons that I mentioned before in the hospitality slide, we think that RevPAR will continue growing, but it will be very likely be slower. The growth will be lower than last year because of the higher base from 2023. Like we saw 2023, the RevPAR was already at all-time highs, so it's hard to see it continuing that double-digit growth. You probably expect a high single-digit growth going forward for RevPAR. So that is one. And another is the fact that they have a lot of inorganic growth potential, where in 2023, they had quite a number of divestments where they divested assets at about a 4% yield, and they are acquiring assets at about a 6% yield. So they're getting the additional spread, and these capital recycling plans can help them benefit their portfolio. And one more thing is that they have about 300 million of divestment gains that they've yet to distribute. So they can just use this 300 million to offset any, perhaps they have some redevelopment plans going on. So when the assets are taken off for the redevelopment, there'll be some gap in this income, and they can use these divestment gains to help to offset the DPU. So as a result, taking into account all these considerations, our FY24, our DPU yield for Escort is about 6.5%, and we have this accumulate rating, and with a target price of $1.04. Yeah, so this is our next slide. So our last topic for the REIT sector today is Cromwell. So this was actually just initiated on Monday, and we have three key points. One of it is very well capitalized. Like looking at their debt maturity profile, they have no loans that are expiring in 2024. The only loan that is expiring is or rather not the only one, the next loan that's upcoming that's due for refinancing is in FY25, which is next year in November. And that is a 500 million euro bond that they've already paid. They've already bought back 50 million of it. So it's 450 million remaining. And this bond is, when they bought back, they managed to book in a capital gain of about 3.1 million. So the thing is that for them right now, their yield is also at 3.2%, or rather not their yield, their interest cost is at 3.2%, and they are well hedged. So their interest, their fixed rate hedges is at 88% of the total loan book. So we think that the interest cost for this year will likely be around the same as FY23's interest. And they have also a divestment program in place where they've divested about 237 million euros of assets over the past 2 years at a divestment premium of about 14.6%. So they've been using, they can use these divestment gains or divestment proceeds to pay off some of these debt to lower their interest costs further. So that is one. And next is they have leases that are also tagged to the inflation index. So we noted that last year, based on this inflation indexation, their rental escalations was about 4.3% based on this. And they also had high occupancy of about 95% and rental reversion potential of about 5% as well. So they have 6 consecutive quarters of positive rental reversions. So we think this is likely to continue as well. And they have a 60-40 long-term asset split between light industrial and grade A office. So this is to capitalize on the growth of nearshoring and the growth of e-commerce in Europe, as well as the grade A office will capitalize on the demand from green, high-quality buildings. Yeah, so as a result, after accounting for, they also have one more thing to note is that they have another 170 million euros of divestments that are in the pipeline, and these are mainly from the Polish and Finnish weaker office assets. And after we account for some of these divestments and the lower income from absence of the divestments over the past year, we have a forward DPU of about DPU yield of about 10% based on current share prices. So our target price for Cornwall is €1.91. Yeah, so that's all for me. I'll hand over time to Glenn, talk about banks. Thanks.
Hey, thanks, Darren, for the very insightful view into the S-REITs. So I'm Glenn. I cover the banking and finance sector, and I'll be touching on the Singapore banking industry as well as a few of my stock picks. Yep, so our title here is Sustainable High Yield for the Bank. So I'll be roughly going through how the banks are going to sustain their high dividend yield. Okay, just the usual disclaimer. So yeah, firstly, we're looking at the interest rates here. Yeah, so let me get the mouse. Yep. So you look at the dark blue line, that would be the Fed funds rates, and the light blue line would be the SORA. So we're looking at it, you can see that the SORA is actually quite closely following the Fed rates, and that's to be expected. However, there's a bit of a dip recently. Yep. So the red line here would be the average NIM for the 3 local banks. And you can see in 2023 and 2022, they both actually did very well. And, it was up 32 basis points and 33 basis points in those 2 years, respectively. However, looking into 2024, we are expecting a slight dip. We're looking at around 6 basis points dip and a similar 6 basis points in 2025. So, although it might seem like quite a steep decline, actually it's still above 2%, and that's relatively high compared to the historical NIM the banks have had. So, just the brief background on how the NIM functions or the net interest margin functions for the bank. Usually they have 2 sides to it. One would be the assets and one would be the liabilities. So there's interest earning assets as well as interest liabilities. So they have to they have to pay the funding costs and then how much they take from the asset yield. So currently what happened in 2023 when the rates shot up, the banks were able to increase their asset yield while keeping their cost of funds pretty low. So that's why you see this huge jump in the rate line in 2022 and 2023. However, what's happening now currently is that the asset yields has been sort of kept at this certain levels, but their funding costs are slowly increasing, which is why the banks have all came out to say that they are not going to be as aggressive with their fixed deposits, and their current accounts as well, current account savings accounts are going to probably lower their interest rates. And we have seen that yesterday, a few days ago, when UOB, they announced their flagship one account, they're going to cut the rates. So they were the first to increase fixed deposit rates in Singapore, and they're also the first to cut their flagship one account rates. So that is quite significant. So the other two banks have yet to say anything, but we could possibly see that happening as well. So that'll be one of the reasons how the banks are able to maintain their net interest margins at the current levels. They're only assuming a few basis points dip in their net interest margins. So moving on to the next slide. Yep. So another way the banks are affected by the high rates, is a double-edged sword. It improves their net interest margins, right? But clearly you can see that the loans growth has been affected quite badly. So you look at July 2022 all the way until April, that's when it was on a very drastic decline, at least a year-on-year growth. And it only started picking back up slightly in the last couple of months. So although the rates are still very high, but I think what has been happening is that the consumers or even the corporates and individuals, they're feeling more comfortable with the high rates. Hence, we can see this sort of flattening of the loans growth. So just, I think, in 2 months ago, so they released the total loans growth figures in February. And I think that was the first time we saw it actually hit zero. So it's flat. And this could be, we've expected loan rate cuts, moving into the second half of the year. I think it's safe to assume that, that mid-single digit loans growth that the banks are sort of guiding is highly possible. So loans growth then will go into the non-performing loans, the ratio. I think we look at this chart here, I think we look at so it's not very clear, but this red line here, that will be the nominal GDP growth. And this orange line here is the average of the three banks' loans growth. So you can see, in 2013 to 2016, the loans growth sort of was above the GDP growth. So the banks might have been overlending, but even then, the NPL ratio only peaked at 1.6%. And we have seen it sort of just gradually drop off. And currently, at least for the last 3 years, you can see that the banks have not really been overlending. So the loans growth has been lower than the GDP growth. And the NPL ratio has also been sort of leveling off. We're currently at around 1.2. And moving forward, I don't think we will see this figure increase much going into 2024 as well as 2025. So we should be stable at around 1.2, maybe even dip to 1.1. Yeah, so this is just a very brief overview of the fourth quarter results. I'll go more into detail later for each individual bank. But just roughly what happened in the fourth quarter was that the NIMs, you look at the first bar, the first two lines here, the NIMs actually took a hit. So we were seeing like double-digit basis points growth for the NIMs until the third quarter. In the fourth quarter, we finally saw some dips in OCBC and UOB, negative -2 basis points, -20 basis points. DBS is the only one that grew like 8 basis points. But net interest income is no longer the main growth driver for the banks. It's all low single digit or even dip for UOB. So what would be the growth driver? And they will be looking at their fee income. So fee income grew very well for the banks, and that was mainly due to a pickup in their card fee income, as well as their wealth management income. And resultantly, we can see that the PATMI actually grew. Yeah, I think one thing I'd like to highlight here is this here, the Common Equity Tier 1, CET1 in short. So OCBC currently has the highest CET1 at 15.9%. And there are two ways basically to lower this, right, to the optimal value of around 12.5% to 13.5%. That would be one, by doing acquisitions, which both DBS and UOB has done. And secondly, would be to pay it back to the shareholders and to give out extra dividends. But then again, So I will go more into it later in the slide in the OCBC, but just keep that in mind when we move forward. Okay, so the other portion for the banks would be the deposits, and one part of their deposits, or their very low cost deposits, would be their current account, savings accounts. So these are accounts like your DBS multiplier, UOB one account, or the OCBC 360 account. The base interest is very, very low, I think 0.05%. So what we have seen, if we look at 2021, 2022, why is there suddenly such a big dip in this CASA and their CASA proportion? Mainly, it was due to the interest rates, and the banks were putting it into the fixed deposits. So they were asking customers to put money into fixed deposits instead of putting into the CASA, which is why there was a big dip, right? And then we saw it level off sometime when the rates started to sort of maintain at the levels. And currently, we are looking at around 18%. And this has been hovering at this level of 18.1, 18.2% for quite a number of months already. But moving forward, when we go into the rest of the year, I think, with UOB doing this UOB one account interest rate cut, we might see it dip slightly, but I don't think it'll be much of a difference, because I think one of the main points for the banks is that they have too much deposits, and their loans has not been growing. So they have nowhere to put these deposits to. So they are okay to release some of these deposits, which they are paying quite a bit of their money to. So that's one way that they can also look at to increase their net interest margins. Okay, so this is the last sector slide I have here. Everything ran. Okay, I think the formatting is wrong. But anyway, there's supposed to be a percent here. Okay, so just looking at the three banks, right? You can see that all of them have majority in Singapore, right? But I think DBS has the largest, which their assets in Singapore, and even though after they had their City Taiwan acquisition, their Greater China, the percent is not here, but yeah, it's still quite small, right? So OCBC, I think, has the largest sort of asset segment in China, and for UOB, as expected, it's mostly in ASEAN, and of course Singapore as well. Okay, so I'll just briefly go through the three stock picks. I put up the three banks, so DBS, OCBC, and UOB. So for DBS, this is just a fourth quarter results. So I won't really go much into it because it's quite, I guess, outdated. But I'll just jump into the outlook quickly. So for DBS, for their net interest income, they are looking at it to be flat for this year, FY24. And they are looking at trade-offs between their net interest, their net interest margins as well as loans growth. So when the rates are cut, then loans growth will go up, but net interest margins should go down. So that's why they are guiding for it to be quite flat in FY24 compared to FY23. I think what they were looking at would be their fee income recovery, and this will be their growth driver for 2024. One way they'll be doing it will be their wealth management income. So they have said that they are currently earning around, I think, 100 basis points spread for their wealth management assets under management. And the assets AUM has been actually increasing steadily, but wealth management income actually has not been moving much. This is mainly due to the markets, it's not doing as well. But going into 2024, at least the second half, they are hoping that it will actually increase slightly. So for DBS, we have a buy recommendation as well as a target price of $38.90. Okay, so I think the next slide will show the big topic, the hot topic at least for the banks, and that is the dividend yield and the dividend payout ratio. So DBS announced I think the big surprise was the 1-for-10 share bonus issue, right? And if we did some calculations, and we came up with for FY24, if they were to maintain their dividend payouts, so not to increase it further, but we add the 1-for-10 bonus share issue, we're looking at based on the current share price at least of $36, we're looking at 6.7% dividend yield, right? And DBS was also very aggressive with saying how much they're going to increase. So during the investor day back in May, they said they're going to do it 24 cents, and they actually pushed it forward. So we saw that 24 cents increase, and then they gave a further 1-for-10 bonus share issue. And if we put in that bonus, that 24 cents into 2025, and assuming it's maintained, we're looking at close to 7% dividend yield, assuming that the share price doesn't move, of course. I think they said during their results briefing it was around 7.4%, but that was when the share price was quite low. So even you include the current run up in the share price, we're still looking at 6.7%, at least for this year, 2024. Okay, so for OCBC, just the outlook quickly. So their loans growth guidance, they're looking at low single digit. I think they're looking mostly in Greater China, and then they have also said their 3 billion incremental revenue increase in that area as well, Hong Kong and Greater China. So their fee income recovery is also quite strong, and they're expecting growth of 12%. We are expecting growth of 12% for FY24. So I think that's all for OCBC. We do have a buy recommendation as well as a target price of $14.96. Oh yeah, sorry, let me go back to that CET1. So they currently have the highest CET1 of 15.9%. And during the call, during the analyst briefing and our talks with the CEO as well as the CFO, they don't really mention much. Like pointed questions are asked to them, like, how are you going to lower the CET1? And they said that, okay, we have done a small acquisition, of the PT Bank Commonwealth in Indonesia, only like 200 million. It's very small. And, the dividends increase in quite little, honestly, compared to the peers. So they did not say no, they're not going to increase dividends, but they did say that their minimum dividend payout ratio is going to be capped at 50%. But they did not say that that's the maximum. So we can only maybe really guess how they're going to do it. But their current, the current dividend yield is around above 6%. So if we're looking at them lowering their CET1 ratio, we could possibly see it even reaching the levels of DBS. But it's really hard to say because they are quite, they don't really say much. Okay, lastly, we have UOB. So for UOB, they do expect, and they are quite forthcoming with it. They said that their PATMI growth will continue into FY24. So, go back to the dividends. They said their dividends will be capped at 50%, right? So that is a very different stance from what OCBC and DBS is saying. They say, 50%, that's what I'm going to do, dividend payout ratio. But how are they going to increase the dividends? And that's going to be by increasing their PATMI growth. So they're saying that, while we are keeping our dividends at this level, we are going to increase our PATMI, and that's how we're going to give back more to the shareholders. So for their fee income growth, we are looking at a double-digit fee income growth, mainly to come from their cards as well as their wealth management. So they also did get a quite big acquisition of the Citibank assets. And currently they also have a lot of tie-ups with all the shows that are going on, like Taylor Swift, Ed Sheeran. So to them, it's not so much about that one-time customer, but they're talking about how they're going to maintain the customer, put them into their ecosystem, and then maybe cross-sell them other products, and hopefully for them to open an account as well. So that's how we see and expect their fee income growth. So we do maintain we have a buy recommendation with a target price of $34.90 for UOB. Okay, so that's the end for the banking side. But now we do have some just a few slides very quickly into what the research team does. So we do webinars, corporate webinars, insight webinars. So what we do is that we invite these corporations, listed companies, to come and join us, and then it's about an hour. It's usually around 12 to 1 p.m. So it's around lunchtime. And what they'll do is that the first half, or the first 20 minutes at least, it will be a very short presentation by the company to show them, to sort of present to the listeners what they do. And then the next 30 to 40 minutes will be Q&A. So you can ask any questions you like, questions that you like, and then the CEO or whoever's there will try to answer them. So it's really a very sort of face-to-face with at least over Zoom, face-to-face with the CEO, and you can ask them questions. So the QR codes are there. These are our two upcoming webinars that we have on the 17th of April, as well as the 30th of April. You can just scan the QR code and you can just join it. It's free, so you can just join, and anyone can just join the webinar. We host about 60 to 70 webinars a year, so there's around more than one a week, actually. Okay, last but not least, we have the Poems Mobile Tree app. So I hope you guys have heard of it. If you haven't, so this is our app that we have. We also have a community that's there. This is basically you being able to interact directly with us, the research team, and ask questions. So you can just ask any question you want on the app. It's free to join as well. So you just scan the QR code, download it, sign up, it's free, and then you can just put in the questions, and we will try our best to get back to you regarding your questions, within roughly a day or two. So hope we'll see you guys on this app. So that's all I have for my presentation. Thanks so much. I'll now hand it over to Ansel. Thank you.
Thank you, everyone. So now we are actually moving to the last segment. Okay, I hope I'm not holding back from you all from leaving this event today because we have overrun slightly. Okay, so basically my sharing just be on this topic, right? So because we are today talking about bank and REITs itself. So we do have these new SDRs that I think just now I mentioned. Just now if you have actually reached the booth, one of the booths is the SDR booth where there's 5 new counters added. And they are the Thai NVDRs that is converted to SDR to trade on SGX itself. So you are trading on SGX and not in the Thai market, right? But it's actually the Thailand exposure. So one of the counters of the SDR actually is relevant to the topic today, which is this Kasikorn Bank. It's a Thai bank, one of the largest one for the retail level, right? So it's actually one of the bank that's the best performing for their domestic bank level, and you will actually benefit from some of the government interest rate environment for Thailand itself. So if you are already investor of Singapore and you're looking for diversification out of purely Singapore banking sector, you can actually look into this particular counter to see if it actually suits your potential needs in terms of investment. So one of the key thing to know is that basically they have the same overall macro outlook as the Singapore bank. Of course, the breakdown of their income or the revenue inflow will be a bit different from Singapore bank itself, right? So you can see over here on top left-hand side, for this Kasikorn Bank, their main inflow will be from the loans itself, and the rest of the segments might not be as large compared to the loans. So it might not be as compared to the local banks, they're not as diversified in terms of revenue inflow. Okay, so but in particular, this is one of them. So other than this, of course, Kasikorn Bank, like I mentioned, there's total of 8 SDRs. So the 8 SDRs, particularly why the SGX and Philip actually work together for these 8 is that they are all from different sectors. So they are all 8 different sectors. The Kasikorn Bank is only 3% of the SET index itself. So there's some exposure in Thailand. But yet, if you want a full diversification, you can actually explore the others. So one of them is actually CPO, you might be familiar, like 7-Eleven brand. So if you actually went to Thailand to holiday before and you bought anything from 7-Eleven, you're already supporting the counter. All right. So basically, they are actually that. And if you're flying into Thailand, you already supported AOT, which is the airport of Thailand. So there are counters that are relevant to you and you might be familiar. If you're an investor of Singtel, you also will know AIS, one of the big component of Singtel, which is one of the investor into AIS itself. Okay, so of course the other counters are also relevant in play. So if you're interested, you can go look for our booth outside this room after the session. You can find out more about SDRs, or you can look for just search for the Philip Securities and the SDR website itself, the homepage, or the SGX page for more details for the SDRs. Okay, so why we're looking at Thailand market is because basically, if you can see, I think we've shown that the ASEAN as a whole performance might not be as great over the last few years, but there is also a point to take is that currently the valuation might be on the lower end. And if you are familiar with Thailand market, you will find that there's some government intervention coming in where they are trying to give some stimulus to support the Thailand market. So in that sense, if you are looking for some alternative from just pure Singapore exposure, so but still trading within Singapore, this Thai SDRs trading within the Singapore hours will be familiar for you. You're trading on SGX platform, you're trading on SGX hours, and you're trading in SG dollar. So there's no Thai FX exposure to be worried about in that sense. And there's some valuation potential for that. So it actually could work for diversification for you, especially for some of the counters that might not be easily available in Singapore. Right. So one of the counters that I mentioned, I think they mentioned is that I think one of the counters is actually on the Thai data centers, which Singapore-wise is not as easy to directly invest into. Okay. Okay, so that's mainly it for the SDR. So we'd like to invite some of the panelist speakers to share on the Q&A that we will have. So if you have any questions, do put them in the pigeonhole, right? So you can join the pigeonhole, the website, and then key in this code. You can put your questions in there. We'll try to address them as soon as possible, and then we can actually have some sharing session for you. Right. So maybe Paul and Josh. Yep. Yeah, so we have Charles also from Philly Capital Management. Okay. So I think we have some questions that's coming in already. So one of the highest voted one will be actually despite S-REIT having a mandate to pay out 90% income with such high yields. All right. From the three banks now, is S-REIT still as an instrument for dividend being challenged? What do you think? So maybe we can have this Charles Sheffers. What's Charles also manager?
Hi, my name is Charles Lee. I'm from Phillip Capital Management. I'm the S-REITs funds manager. So I'm covering the S-REITs and a couple of funds in PCM itself. Basically, we did this. Sorry, let me understand this. What do you think? When we talk about dividend yield itself, of course, there's always the flows of the payout and the earnings itself. Of course, if you strip the whole S-REITs into different segments, we have to understand where is the income coming from. Of course, everyone will have an understanding that it's all real estates. But I think if you look at the different segments, especially over the past 1 year, the whole landscape actually has been greatly challenged in the sense that the cost of funding has actually spiked up. SORA, now is standing about 3.7, as compared to 2 years ago is about 25 basis point. And so if you know, SORA actually tracks the Fed fund rates to a great extent itself. So all this is actually will impact on the income, the DPU itself. So this is the general landscape for all the S-REITs in Singapore. And this also will be continue towards the end of this year or even towards the beginning of next year, because we are seeing the cost of financing actually will increase as the S-REITs refinance the debts this year and next year itself. And of course, the next question is always asking about the Fed fund rates, when will it be cut in that sense? If you read into the narrative of the Fed itself, I mean, they have been always saying there'll be cuts itself. Market also is projecting there'll be 3 cuts this year. But I think they are very firm on that the target inflation rate of 2%. It has always been there. And I guess my understanding is that if the Fed doesn't achieve that 2%, and everything goes well, they'll still hold on to the rates until they hit that 2% inflation rate based on the PCE itself. Now, of course, if you look at the other side of the business, which is the earnings portion itself, then you got to strip, look at all the different individual assets. If you look back 2001, when the S-REIT industry actually started, the formation is actually quite easy to understand. Retail is retail, office is office. But these days, after 20 years of evolution itself, of course, because of the managers, the sponsors, so-called trying to diversify, they actually added more different segments into the same structure itself. So that makes the understanding of the asset class a bit more challenging. But of course, if you look back the past 1 year in terms of the DPU, I would say over the past 1 year, the DPU actually reduced. I mean, only those with the Singapore-centric, they tend to do better in that sense. I mean, in terms of the performance, the Singapore-centric also are doing better. Yeah.
Yeah, they do this. The guys know how long I can yap for, so they usually cut my microphone. Sorry. Just on that question that had the highest votes, definitely REITs have been looked at more as a trading instrument than an investment instrument with the outlook for interest rates over the last 2.5 years or so. There's, I guess, ultimately at the end of the day, it's not just the financing costs that are potentially reducing the distribution yield, but also the competition in terms of what's out there with high yields. You know, Singapore has a number of stocks that are less traded. We've got 80 stocks that have double-digit return on equity, single-digit price earnings ratios, and competitive returns over the last 12 months. That they all maintain yields. They're competing. One thing I think didn't take that through the macro juncture of the last few years that didn't really take off as much as it should have, which was a shame, was the REIT futures, the IHS REIT futures, which basically take a lot of their value from the top 10 REITs. That is obviously your CapitaLands, your Keppels, and your Mapletrees and some Frasers. And the relationship between the actual price of the index and the expectations of interest rate cuts and the fluid developments, whether it's Fed speak or FOMC meetings, that have really made REITs quite tradable. I think we kind of missed an opportunity there. You can trade REIT. We got to get the Phillip Capital guys in. They can next. I think they're coming in a couple of weeks, and I'll talk about trading REIT futures and so forth. Okay, so you know, obviously there's still some aspect of the REITs that maintain the higher yields, and as we said before, you're looking for REITs with distribution income that is actually growing. There's not so many. You're looking for those that are making the accretive acquisitions, positive rental reversions, the rev power, which we saw up before. A lot of these metrics matter. So ultimately, if you are still using the S-REITs as part of your investment portfolio and so forth, which I know a lot of people are, then I guess what you are doing is being more selective when it comes to the criteria you're using in chasing the yield in the REITs.
Okay, so actually, after we answered some of the questions from S-REIT side, let's move on to the banking side itself. So thanks, Charles and Jeff, just now. So do you expect the SG Bank to actually sustain and increase their dividend, even with the reducing future interest rate projection going forward? So maybe then, Paul, going to start first on whether or not the projections will be affected.
It will be a challenge, I think, if they want to maintain their payout ratio at 50%. They can pay. I mean, although, like what Glenn said, the banks are well capitalized, there's actually a lot of hidden reserves. Hidden reserves because they overprovide. DBS overprovide 2 billion. It's like put 2 billion in the piggy bank for rainy day, which never happens. And also the new rules, a bit more complex, but there's a new Basel rule which will actually release, I think, about 20 billion of capital for, if I'm not mistaken, the number, I need to really recheck, 7 billion maybe of capital for DBS. Because the bank capital rules are so high, but now they have to come down because the world is so low, the capital ratio. So they got excess capital. That's why you can see DBS willing to pay. So the problem is the willingness to pay. DBS willing to pay, OCBC, for whatever reason, is not willing to pay. I don't know what rainy day they're waiting for, but anyway, they're not willing to pay. So the debate is whether the earnings can stabilize. It is not an easy answer because of the net interest margins. This year, we still think we can, because with the rates being delayed. There are a few moving parts. That's why we don't have a clear answer. It depends on loans growth. And you know, Singapore, there's nothing much to lend other than property. So we're not very hopeful on that. Then the tricky part will be on wealth management. So for wealth management to grow, you need investors to suddenly want to take risks. Instead of putting money in deposits, your private bankers to convince you to buy unit trust and go and take risks. So that's why the deposits income, the interest income has to convert to fees. So that's the second moving part. The third moving part is NIMs. I'll give you a very compact answer because there's really not a very simple answer because there's too many moving parts. So next one is NIMs. So for NIMs, it's a bit tricky. Competition. So we think NIMs can drop a little bit, mainly because of competition if UOB can act that way. And also another complex thing is that they are repricing everything. So they got a lot of very low price assets, which they're repricing to higher yield. I mean, that's to make it really momentum. So we think they can hold the yield. DBS is the safest bet because they already committed. They already told you they're going to pay this much in 24. The other two banks, may or may not, because of the payout ratio, they are very sticky on the payout ratio. So if earnings dip a bit, they may not want to pay. again, yeah. Sorry, it's a very long answer because it's not an easy, straightforward answer for banks. Because the debate is whether earnings can hold. That's the key thing.
Yeah, so maybe I just add in this question for then Jeff and Charles can both answer together also for this aspect is that for the next question is there's this in terms of dividend returns, risk to reward ratio, which is more attractive now, REITs or the bank stocks and why? So maybe Jeff can actually answer in relation to the past question also.
All the banks are trading at premiums to their so the current price to book ratio is at a premium to their average 5-year price to book ratio, whereas your REITs on the other hand are trading at something like a 30% discount, 20 to 30% discount. So DBS is trading it has the biggest premium, and that's one way to look at it. As we said before, most of the REITs and the 3 banks, they all have analysts that cover them, and they have consensus estimate target prices. And on average, the 3 banks are around 5% below their 12-month target price. Whereas when you look across the REITs, generally they're around 20%. So they're very different at very different context to where they're moving up. So you might look at potential upside, potential is less for the banks, but it's more stable with the dividends. And that dividend amount, like Paul was saying, look, when you look at it, ultimately what we want, and what we want is not what we get in markets and economies, as you know, is a smooth landing. And the smoothest landing, theoretically, is where, yes, your NIMs come off with the reduction in the interest rates, but the economy is so strong that loan growth can help to offset those changes in the net interest margins, while the strong economy also supports the stock market, which also supports the non-interest income, and the consumer cards business as well also gets supported by the strong smooth landing per se. So the smoother the landing, the more sustainable the dividends. But I think that they're 2 very, very different markets. One's obviously to do with real estate, one's to do with financial services. They're very different aspects of our economy. Financial services is obviously a much bigger part than the role that real estate plays and so forth at the moment. Digitalization is a much bigger part of the banks. And I think also the China economy and the growth of the region does have more to do with the REIT market here, in certain aspects, such as the industrial and the logistic REITs. And then you've got a different potential whole trading theme when it comes to those REITs, because they will benefit from the increase in manufacturing activity if that cycle does pick up, as well as, and there was a question there as well on the data center REITs, which can also benefit from the rollout of the computer devices that are more AI facilitating and so forth. So you're very different.
Yeah. So Charles, maybe.
I think what Paul has just mentioned about the capital ratio of the banks, they are well capitalized, and I think over the years when the rates has increased, the banks actually has enjoyed all this so-called profits, and then I mean they are willing to pay dividends. On the flip side, I mean the REITs, which I mentioned earlier, the past 1 year, 2 years, they have been suffering because of the rise of the interest rates itself. Of course, the expectation of rate cuts, everyone is hoping there will rate cuts, but the rate cuts will be gradual, and then that magnitude of the rate cuts will not immediately trickle down into the lower cost of fundings for most of the REITs. But if you can see that, which I mentioned, the maturities, some of the maturities coming online this year and next year, actually they are borrowed 3 to 5 years ago, and 3 to 5 years ago, actually the REITs is actually at a low level itself. So you won't see the kind of a big decrease in the cost of funding on the debt profile of the REITs itself. So, and in this aspect, the risk level still maintains. But of course, on the flip side, if you look at the assets, the rental reversions for certain assets like the retail or even the hospitality has actually picked up. There are other areas we still need to assess the quality, which I think Joe has mentioned, the supply around the individual assets. For example, Singapore itself, we have a projected stable supply for hospitality in the next to 2026 itself, which is about a CAGR of 2.6% as compared to the pre-COVID. I mean, for the past 8 years, this is about around that 2% itself. So this is actually something that we are quite comfortable with, and it will not create the kind of a big price or maybe the room rates decline over the next few years itself. I mean, this is what the Singapore government has managed very well in terms of the hospitality side of things. So I would say in terms of the dividend returns, the REITs will still face challenging for the next 12 months, at least 18 months. But of course, we are very, very selective. If you pay more attention to the quality, like healthcare, like hospitalities, I mean, these are more resilient, or even the Singapore retail scene, which is quite well supported by the government's funding on the consumer side of things. I think this also will help the dividend returns for these different assets. But on the general, you can't look at things on the whole REITs, but you have to look at more selectively. Yeah.
Yeah, and there's so much differentiation within the sector. If you're having 60 to 70 investor relation engagements in a year, it means you're going to have your fair share of REITs there. And there's a lot of differentiation, whether you're looking at Capital Land Ascent, the India Trust, the Capital Land India Trust, sorry, and you compare that to, it's very different to commercial offices in the US and so forth. So very, very different.
Yes, so thank you. I think the focus was on the hospitality and the retail REITs. So as a summary, so you can actually look into them if you're interested. The next one is actually related to what Charles just slightly mentioned just now, is that now that the rates are expected to fall, is this still a positive trade for S-REIT to have a high percentage of fixed rate loans? Is this something that the investors like, or is it increasing in terms of percentage? And in this aspect, also add one more line is another question that someone have is, what is a whale? Maybe you're going to share together with this question. So maybe Charles can start first for this one.
I guess this is also a very challenging moment on the expectations of the rates falling itself. I mean, especially those REITs are facing on the refinancing part of things itself. Whether should they fix their rates moving forward, or should I? It's something they have to ponder. I don't have a crystal ball on that, actually, honestly speaking. I mean, they have to take a call. It's just an SIA, how much percentage of my airfield I need to hedge off. I mean, there's always a projection of where the REIT cuts, a probability of that. It might be wrong. I mean, every REIT manager will have their own set of the decision making when it comes to that kind of fixed rate. I mean, fixing the loans in some ways.
Yeah. Any Manulife also fix their rate loans, so it doesn't really matter. I think for us, most important is the consistency. If you're going to hedge, you just hedge it, because hedging is just to iron out the volatility. Then just keep it consistent so that you're not taking a position. On the question of whale, was it a whale, right? Okay, so any whale is a weighted average. That means how long you lock in your tenant. I mean, if you rent out a property, how long the tenant is stuck with you. In the past, it was viewed very good because the tenant is stuck with you. But it also means that you cannot raise your rents that much. So why would you want to rent someone 7 to 8 years? It's also because there's not much demand to, right? If you know your rent is going to climb up, why would you want to rent at 7, 8 years? Of course, pre-Manulife, everybody liked that because it was a sign of our security. But I think post Manulife, I think investors begin to realize locking in long-term rates also is a reflection of the quality of your tenancy. Like some of the data centers, they lock in 10 years, 15 years, because they're talking to Google. Obviously, Google as a tenant, they tell you what to do, not you tell them what to do, right? So locking in for long-term isn't a good idea, especially the painful lesson of rising interest rates. So when rates rise, what is your key objective? Is to outrun the interest rates. Who can outrun interest rates? Is the hospitality REITs. Because every day you price out, you come in today, your room rate tomorrow change, I price you higher. So I can outrun interest rates. It was good when you have a declining interest rates, and that was fun, but now the rates are elevated, unlikely to drop. So keeping a long wheel isn't as fun as it used to be, anyway.
Okay, so I think we have addressed that particular question. So next one, maybe we can have our last two questions, perhaps. I think we have slightly overrun the session today. So do we expect the non-interest income, like wealth management, for example, and loans growth to make up for the reduction of NIMs for the Singapore banks going forward with the expected rate reduction trend? So I think there's two parts, is that whether the NIMs will actually reduce with the expected rate cut. Second part is whether the non-interest income can actually make up for it.
It's hard to do that, right? Because the net interest income is twice the size of the non-interest income for the banks combined. Yeah, so it was 48 billion total income last year. 33 billion was net interest income. 15 billion was non-interest income. You want loan growth, higher loan growth, obviously, to help offset the NIMs, the reduction in the NIMs. And the wealth management aspect of it, I think you could look at stocks like iFast Corporation as well. You've got CapitaLand also moving into financial funds management, as you have Keppel as well with what it's trying to do with the European real estate funds as well. There's a lot of kind of segments adjacent to the three banks. If you're looking at that wealth management type of activity, even Yang Zhejiang Financial Holding is also a play in the in the regional wealth management. So that's one aspect you might want to look at.
Okay, so I think we just have one last question. It's just the highest voted one actually. So what is your opinion on REITs with exposure to data center, given the AI tech wave currently? So I think for Singapore, we do have some. So maybe Paul or Charles want to share some on this aspect.
I'm not so optimistic. I mean, from the top down, of course, it should benefit. But the problem is, it's not about the REIT. No, it's not about the data centers. It's about the power. Who has power is the winner, not who has the data centers the winner. Because even though, assuming the tenant leave, can you bring in the AI? You may or may not bring, because the AI servers they're using, the power dimension is like 10 times more than what they have. So initially we thought it will, but upon closer check, they may not be able to write that technology way. And if you're going to write the AI, just buy NVIDIA. I'm not going to buy it through a data center, right? So it's a waste of time. But for us, we think that it can still hold. I think the tenancy, there will still be demand for data centers, but don't hold your breath because AI, because they may not be able to spec in. The demand can be 4 or 5. Like one server could be you have to put in liquid cooling because like it's almost like burning hot, and whereas you're not used to it, so your existing data centers may not be able to cope with it. Yeah, but I mean, I'm not sure I answered the question.
It's identified in the IR slides and so forth for the data center REITs as a potential growth driver, obviously 5G or and AI and so forth. But if you look at stocks globally that have the AI exposure, there's about 30 different revenue streams, like all the audio visual and industrial. So it's within 3 key sectors: software, hardware, and industrial application. 30 different revenue streams across those 3 industries, and you can identify those stocks that have those different revenue exposures. Obviously, a lot in the US. As we know, all those common names, familiar names, I should say. that give you the more of that exposure, direct exposure to AI, and then there's adjacent to AI as well, such as the semiconductor value chain, or the software companies like Silver Lake Access, which incorporate it. We use it. We use AI for, I mean, two very small parts of our operation, basically for anti-money laundering, for their surveillance in there, as well as in the corporate announcement page to help sort, where the corporate announcements should be correctly categorized as. So it's a very small part, but as I say, if I can share that with the Philip team. If you want to know a list of, let's say, 30 stocks, they're not listed here, they're listed in the US, but they've got all that exposure to all those different revenue streams, if that helps.
So maybe I should say, anyway, data centers now, they have pure AI data centers. You don't have to use the old data centers like YTL Power is working with NVIDIA to build one, just all AI, all GPU chips in it. So you don't need to go and use whatever old data centers because the demand, the cooling is just totally different. So that is the transition. It's not the old data centers using AI, but just pure AI, GPU, NVIDIA GPU, H100, whatever you want to, or Blackwell, whatever. That is the techno, that is the wave, not plug it into some old data centers.
I think recently I was watching this, Jensen Huang was talking about his business model itself. I mean, he has managed to zeroize his cost of computing to a great extent that even his customers, his competitors offer the chips, even cannot compete cannot compete with his chip itself, which means that the power of computing is so great until they can even remove the whole data centers with its installation itself. So that is also a question, which I'm still looking through in the sense that how would that impact the whole data centers industries globally itself if it's dominated by NVIDIA's chip itself. Basically, I mean, if all the clients go and use NVIDIA's in some ways, the space will be safe in a very great way, which means they don't need so much space for data centers as before itself. So this is something that still in a question mark.
Yeah, so I think to summarize, basically just to understand that data center REITs or exposure, REITs that have exposure is actually still REITs. Yeah, they're not the center themselves, they're not the AI themselves. So just be aware that they won't give you the returns that you're expecting of AI companies directly. Okay, so I think with that, we should come to the end. We are at 8:50. I'm sorry for the slight overrun for the session. I hope everyone have an insightful session with all of us and had a great dinner just outside. So if you have any questions, feel free to reach out to the Philip team also and SGX team and the booth outside. If you have not collected your goodie bag, do collect with my staff outside as well. Right, thank you very much for everyone.
Thanks for coming all the way.
Now I got you right by my side. Yeah, I got you right by my side.